Hi, I'm Amanda Morell, Personal Finance Editor with Interest.co.nz, and this is one of our double shot interviews. I'm joined today by David Beattie. He is the Joint CEO and Joint CIO of Grosvenor Financial Services, which is one of the many KiwiSaver providers on the market. David's here to talk to us about how the fund is managed, how it works, and what sort of style they use. So to start, David, can you explain to our viewers what is your investment philosophy at Grosvenor?
There's a lot of debate around the world, for that matter, about what's an appropriate investment strategy. Should it be predominantly invested in passive or index type funds, or should it be following a more active route? We decided quite some time ago that there was not a lot of merit in taking a sort of fundamentalist approach to either of those two things. We think each of those styles has merit. Yep. And so our core philosophy is to have around about a 50-50 mix of the two things. Yep. So we capture the markets through some good, efficient index type funds, and then around that we'll add some very active satellite strategies to capture some really good value out there. There are excellent managers operating in that space, and we have just a very select few managers part of our suite, including one of the more significant ones being Rothschilds, who operate out of Switzerland. Okay. And they help us to put together just a tight, highly concentrated portfolio of 15 to 20 stocks invested around the world in some of the core key top-down themes that we believe are important going forward, and which we believe will add considerable value over and above what a normal market index would do.
Okay, you mentioned just before we came on camera that you choose your investments around particular themes. So what themes are you keen on right now? Where do you see long-term merit for KiwiSavers?
Well, I think if you look out 15 to 20 years, there are some pretty clear themes that are going to drive a lot of investment opportunities going forward, particularly the ageing population, which in itself brings issues centred around really good healthcare. So quite a number of stocks in our portfolio focused on healthcare and the provision of that. Also, with the growing population, you've got demand for core commodities, food, water, alternative energy is going to be something that will be critical going forward. One interesting theme that we've discussed extensively with Rothschilds is about the growing change of spending patterns amongst the Asian part of the world, particularly China, where both the previously described sort of poor class are moving into middle class, and the middle class to the upper class, and that's generating demand for high quality goods and services that we would have perceived to have been luxury goods, for example, and some of the big name brands, for example Louis Vuitton, is generating around 30 to 40% of its revenue out of Asia. So huge demand. So those sort of themes, I think, are themes that are going to last for a while.
Okay. And with respect to fees, what's your approach on that? Because with a lot of actively managed funds, you tend to see a higher fee, but you're quite conscious about trying to control the cost. So how do you walk the line there?
It's a delicate one. It's one that's going to cause ongoing, continued debate in the KiwiSaver space. From our perspective, we think it's far more important to focus on what fund managers can generate in terms of returns after fees. And if they're doing a good job in that respect, then I don't think the fee issue should be as focused as it is. Okay. There are a number of very good managers who are household names in New Zealand who charge close to 1.5%, who are not included in any KiwiSaver funds simply because of that 1.5%. And yet after that 1.5% fee, these managers have generated double-digit returns for the last 10 years. Right. Which from my measure is the most important significant item. So I just hope over time that we get this, a bit more perspective on the issue of fees and the importance of fees in terms of the overall determining factors behind choice of KiwiSaver providers and what are the criteria that people should be looking at. But unfortunately, it's taking up too much of the headlines at the moment.
It is quite a bit. So with respect to local fund managers, you've got your own team and they manage the New Zealand and the Australian equities, is that correct? Or?
They do.
Yeah.
And again, it's done that way because we want to make sure we've got consistency with the global themes. The danger with using, from our perspective anyway, off-the-shelf sort of fund manager products is you can't tailor them to be consistent with what is happening in other parts of your portfolio. And one of our core planks of our philosophy is that we must make sure that every component of the portfolio is working well with every other piece of the portfolio. So, for example, we believe that financial stocks are best captured in Australia, so we emphasise financial stocks in Australia. Our mandate with Rothschilds is we don't want global financial stocks. Because we've got Australian-based financial stocks in Australia, we don't have the equivalent financial stocks in New Zealand, so we tailor things accordingly. We buy a lot of research in about the individual companies themselves, and then after having applied the various filters that we use, then we select the right companies to represent the sectors that we believe are the ones that are most consistent with the overall global themes.
Okay. Another sort of distinguishing point of Grosvenor is your currency hedging strategy. So if you could just elaborate for the benefit of our viewers what your strategy is with currency.
We're very active in terms of the currency strategy that we apply. At any point in time, our international shares can be between 20 and 80% hedged. We'd normally sit around 50% if we didn't have a strong view one way or the other. We have found that in looking at the KiwiSaver manager space, that most managers typically are following around about a 50% strategy, but they're not altering it much around there. We really strongly believe that from a holistic viewpoint with clients, the currency strategy is probably the single most important potential determinant of their long-term wealth aspirations, particularly as you approach retirement as well, because of how much dependency we in New Zealand have on currency-related fluctuations in terms of our standard of living. And if you take a sort of a really high-level approach to risk management, then a New Zealander should actually naturally have most, if not all, of their international investments unhedged. Because we know that if some local disaster hit our economy, for example foot and mouth disease, the New Zealand dollar would drop about 30 or 40% overnight. If you've got a whole lot of international investments that are fully hedged back to New Zealand dollars, they're not going to get the benefit of the fall in the currency. And yet, as the standard of living in New Zealand's collapsing around our ears, the only thing that you could potentially say is going to help to offset some of that is to have some offshore investments unhedged. But from time to time, the New Zealand dollar will go up, and you just have to live with the fact that it'll go up, and that'll affect the value of the portfolio while that's happening. And that's been a feature for our funds in the last 12 months. But since the inception of the portfolio in 2008, the volatility associated with having a relatively low level of hedging has played quite an important part in smoothing out a lot of the risk factors that otherwise would have affected the portfolio. So we're going to stick with that philosophy. We think it's appropriate. We think New Zealanders need to have managers out there who are taking a more absolute sort of return focus, particularly on their the risks of them losing significant portions of their capital.
Now, people tend to go into your fund through a financial advisor. In fact, that's the only way they can come into Grosvenor. Why is there that relationship there, and what value do your members get out of that as a result?
It's all included in the fees. Having an advisor who's there available 24/7 to talk to them at any point in time about any matters that might concern them. At the moment, with balances relatively low in its infancy, there's not a lot of value that seems to be ascribed to that. But we know from our experiences in Australia, where after superannuation has been going for some time, average balances in the KiwiSaver will continue to increase. There'll be a point when they're above 50,000 on average, close to 100,000 as they are in Australia. And we know, looking at Australia, that Australians really value having a good financial advisor available to help them to make some critical decisions about their $100,000 nest egg as they approach retirement, and all the other sort of ancillary issues that relate to that in terms of risk management and insurance, estate planning, etc. So we will continue to emphasise the role of having a financial advisor as part of the whole proposition. They will also significantly help New Zealanders increase their financial literacy, far more so than I think they can do themselves or read on the internet or books. So we're strong believers in that relationship, and we'll continue to incorporate financial advisors into the whole proposition.
Excellent. Well, it's a 2-for-1 deal then.
It is. Absolutely.
Okay, David Beattie, thank you very much for joining us. I'm Amanda Morrell with interest.co.nz, and this has been another one of our double shot interviews.